we have revised our projection for global growth downwards to 3.6% in both 2022 and 2023.
China, supply chains, new variants, what happens in Ukraine, those are giant elephants.
Probably we are going beyond neutral.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Chicago Fed President Charles Evans expects the Fed rates to go beyond neutral next year, while the Atlanta Fed President Raphael Bostic says the central bank should retain some caution. Cancel culture: Netflix plunges 25% after hours as it loses customers for the first time in a decade and signals more pain ahead. And stay with Bloomberg Surveillance Early Edition. This hour we have a top lineup of guests, including economist Jim O'Neill and Hendrik du Toit. He's the chief executive of asset manager 91. You can send in your questions for both of our guests using IB plus TV Go. But first thing is first, so let's check on the markets. And of course, this rising real yield means that we could see a bit of ups and downs when it comes to stocks. I think U.S. futures are seeing, of course, a downturn. The NASDAQ futures down some 0.8%. This is because of valuation. As real yields go up, valuations, for example, for stocks could come into question. European stocks, though, are still supported, gaining some 0.3%. Again, if you look at the U.S. 10-year real yield turning positive for the first time since March 2020, it could be, or it could signal a potential return to the pre-pandemic normal. What that means for a number of asset classes, the big question we'll try and answer. And you can see yen 128.69. We're having an interesting conversation with Marcus Ashworth, saying, what does it mean for the BOJ? Could they like to see a bit of inflation? Probably, after the stagflationary environment they saw over the last couple of decades. Now, if you zoom into what's happening individually in a lot of these countries, you can see the FTSE gaining 0.1%, but actually it's the DAX that's supported, I think, 0.3% higher, the CAC 40, 0.5% higher. I'll be watching that debate ahead of the second round of the French presidential election. Stay with Bloomberg for full coverage. We're also live on Sunday nights. But tonight, 8 p.m. UK time, Marine Le Pen faces Emmanuel Macron. Last time round, it was a huge, huge deal that really almost won Macron the election. Credit Suisse, one of our biggest corporate stories today, coming out saying that they will have to put, that they're basically struggling to book some of the value because of Russia. They're reporting also earnings on Tuesday. Credit Suisse down some 1.8%. Now, U.S. 10-year real yields have turned positive for the first time since 2020. Investors pricing in a more aggressive Federal Reserve as it tries to bring inflation under control. Now, here's what two regional Fed chiefs had to say on the issue.
Obviously, if inflation for some reason began to reaccelerate, I think that would be a cause of great concern. I think that, on a path that included these 9 increases for this year, by, December, on the way to December, you'd be looking for any confirmation of the storyline.
We have to make forecasts, and we do our best. But things like China, supply chains, new variants, what happens in Ukraine, those are giant elephants that are going to determine what happens to our economy as well.
Now let's get into the key market drivers with our markets editor, Christine Aquino. Christine, it's all about real yields finally positive. What does it mean for the assets that will win and lose the most?
Well, Francine, I think your market roundup sums it up really well. Bonds are slightly up today. That makes a lot of sense because it's finally attractive for investors to get into these fixed income securities. Stocks are slightly softer, particularly in the U.S., because that's where you find those highly valued growth sector stocks. And Europe is enjoying this a little bit because it is the land of value, and it's an environment that makes sense when you see real yields kind of turning positive and giving a little bit of boost for the bonds. It's also a bit of a boon for some of these cheaper stocks, especially compared to the U.S.
Christine, talking about divergence, so you're talking about divergence of stocks, but what do you do with, for example, U.S., China, and in terms of growth, in terms of also what central banks are doing?
Yeah, it's very interesting, Francine, because the narrative of slower Chinese growth is really, really taking hold. And you can see the PBOC wanting to respond to that by delivering some easing measures that are both broad and targeted. We saw the latest round of measures really taking a look at that credit sector in particular. And of course, the weaker yuan playing into this as well. I mean, some of the divergence we're already seeing play out in FX, again, by way of a stronger US dollar versus a weaker yuan. We're also seeing that playing out in the bond markets because, and this is part of the positive real yield, US real yield story, right? That rate differential argument that had been a benefit to Chinese bonds in the past, is really disappearing. I think the premium of Chinese bonds over treasuries is very, very little now, if not completely gone. And that is very much a consequence of what we've seen, the divergence in the Chinese and US economies.
Christine, talk to me about Netflix. So the school of thought says, look, they just don't have the content, so people will migrate to Amazon and Apple TV. Others saying, look, if inflation's going up, you cut your spending and the streaming services go first. Actually, pre-market, we also need to watch pre-market, otherwise my producer will put me in the doghouse. Pre-market, it's down 25 or 35%, 25%. There you go, Netflix down 25%. I mean, it's ugly.
Yeah, massive, massive loss for Netflix. And yeah, very interesting narratives that are playing out. It really depends, whether you're a bull or a bear. You can, it's a plethora of narratives that you can latch onto. But another interesting take on this that I've seen is that this could actually be a sign that those lockdown pandemic era plays are really, their moment is over, because people are going out into the real world and spending elsewhere. So it could potentially be a reallocation of consumer spending because we are seeing consumer spending still up based on credit card data from the major banks last week. It's not that it's gone away. It's perhaps just going to different things, spending on, I don't know, travel or, yeah.
or better content on TV.
Exactly.
Christine,
yeah.
Thank you so much. Christine Aquino there, our markets editor. Now, to talk about all of this, I don't see him as a Netflix and chill kind of guy. It's Lord Jim O'Neill. He's former Goldman Sachs asset management. He is, of course, also ex-UK government minister. Jim, I don't have you as a Netflix and chill, but actually, have you had to be sedated after the football last night?
I was going to say, I wish I was watching Netflix last night than watching United getting stuffed against Liverpool. Netflix would have been very useful last night.
I thought it was horrific. I know you thought it was horrific, but not unexpected. Also, for those who don't know, Jim O'Neill is literally the biggest football fan.
I think I might even have said on some previous discussion with you guys about the way Manchester United fits in the world of business and sports. It's the ultimate example of profit without purpose. Utter shambles, but so long as everybody all over the world is talking about how bad they are, as certainly you look at the airtime given to Manchester United since the game finished, you would think they were the team that won. There's virtually no mention of Liverpool, and that to these weird owners of Uniteds that are constantly looking for ways of commercializing revenue streams from advertising. Bizarrely, they're probably perfectly happy about it, despite it being, I think Gary Neville said, the worst Manchester United performance he's seen in 42 years.
So why not, try and put a consortium together again and buy it out? Give me some news,
well, I have
Jim.
to say in that regard, it will be very interesting to see how the final days of the Chelsea buyout goes on, because that obviously does suggest one can put consortiums together to do this sort of thing, let's say. But against that, if Chelsea goes anywhere near the talk of £2.7 billion, the kind of money to extract United away from these dreadful owners will be probably more than that, possibly substantially more. And it doesn't seem like it's very attractive in terms of value.
Okay, I do also need to go back to my wheelhouse, which is real yields, Jim. I'm not really sure how to go from like football to that, but actually it just goes back to repricing of markets. Maybe it goes to repricing on some of these football clubs, whether you agree with it or not. Real yields going up. What does that mean? Finally, I guess, is what a lot of people in the market would say. But why is the market readjusting now and not two months ago?
It's a very interesting question. And it's something that I think is really necessary. I've become more and more of the opinion over the past 12 months that we've been living in fantasy land with the way that QE has just gone on and on and on, and it serves no great economic purpose. It actually serves a social dispurpose. It does make the likes of ownership of Manchester United by the Glaziers easier because they can refinance their debts periodically so much easier at these artificially low real rates. And it is, you joked about it, but the parallel is very strong with parts of the tech sector. And I think the reasons that are driving it are twofold. One is, of course, we have inflation now no longer being regarded as transitory by central banks. Yeah. So they're having to get in front of the game, as you've seen from some of these Fed comments overnight. But the second thing, which is something I wrote about for Project Syndicate recently, which I think is a more powerful development perhaps than I see discussed relative to others, is that the whole freezing of Russia's central bank assets raises the whole notion of the much discussed global savings glut of the past 20 years, actually no longer having a lot of substantial legs. Why, if you're central bank X in Asia, why are you going to keep accumulating foreign exchange reserves anymore?
Jim, you need to come and co-anchor with me. You're stealing my thunder. This is what we're going to talk about next. Is it the end of the global savings glut? We'll be back with Jim O'Neill. Also coming up later on in the program, we talk with Hendrik du Toit. He's the chief executive of Asset Manager 91. But up next, as Jim was saying, we talk, of course, about the savings glut with Jim. Don't forget to send in your questions to IB Plus TV Go. This is Bloomberg. Welcome back. This is Bloomberg Surveillance Early Edition. Now back with us, leading British economist Jim O'Neill. He's also known for coining the acronym BRICS. This will haunt him for the rest of his days. It stands for Brazil, Russia, India, and China, as they were the main emerging economies in 2001. The term since lost its significance due to the diverging nature of each country's economic development. Now, Jim, actually, what you're really on to talk about is the end of the global savings glut, which was a wonderful piece you've also written for Project Syndicate. What does this tell us about what kind of markets, but also what kind of economy we'll live through in the next 2 to 3 years?
Well, there's more and more things that come out that it makes you, somebody certainly of my generation, find it impossible to avoid constant reference to the 1970s and periodic market focuses or foci on so-called stagflation. But on the savings glut, you know, as I wrote in that piece, I was always a little bit skeptical about its true academic strength as an argument. It was popularized by Ben Bernanke before he became Fed president. But, you know, in essence, the argument was all these countries with massive savings in Asia, particularly China following Japan, would just keep on accumulating foreign exchange reserves and keep on piling them into risk-free assets in the West, particularly US treasuries. I don't really believe that theory is as powerful as was perpetuated, but crucially in the context of central bank behavior, it became a very persuasive self-justification for pursuing a very accommodative monetary policy. And now with the end of the with the freezing of Russia's central bank assets, you know, ask yourself, Fran, if you were running the central bank of China or central bank of Kazakhstan, would you keep buying foreign exchange reserves to just put them in US treasuries or euro bonds on the risk that if you did something wrong, they might be frozen? I think at the margin, the answer is almost definitely not as many, and maybe no, I wouldn't.
But so Jim, what does it mean?
We might have seen peak foreign exchange reserves.
Right, and Jim, so does it mean that we're seeing the end of the dollar as the dominant currency, and how long, in terms of time frame, does it take for that to go away?
I mean, what I think it really means, it adds into the mix of the inflation issue that's come onto the scene, is that it might indeed be the beginning of the end of a 40-year bull market in bond markets. That would be the biggest consequence, which has all sorts of consequences for everything. On the dollar, I'm not sure. It could be, because obviously US bonds are by far and away the biggest part of this global savings story. But because of the Western alliance, it's not just US bonds that have been frozen with Russia. It's also those of the Euro area and those of Japan and Australia and so on. So it's not itself directly dollar specific, but because there's so many other issues that go on, it might well be in parallel that this finally forces some places like China to think, well, we have to come up with a true alternative where we can store liquidity and allow people to more genuinely use our currency. And at some point in the future, that will happen. Whether that's this week or next week, who knows?
Jim, thank you so much, as always, for your brilliant thoughts. Jim O'Neill there, of course, on all the game changer for some of the Treasury holdings and dollar reserves. Now, coming up, we're live in Helsinki as Finland debates ditching neutrality and joining the NATO alliance. That's coming up next, and this is Bloomberg. Finland's parliament is today debating whether the country should drop its policy of neutrality and join NATO. Now, both Finland and neighboring Sweden say they are stepping up consideration of the issue in the wake of Russia's invasion of Ukraine. Now, let's get more with Bloomberg's Maria Tadeo, who's in Helsinki for us with a guest. Maria, over to you.
Yes, Francine, and what a day to be here in Helsinki. This big decision about NATO that is, of course, sending shockwaves to the region. As you say, it's not just Finland, it is Sweden. But today, of course, the focus is on Finnish politics. And to talk about it, we're now, of course, joined by Joni Ovaska. Thank you so much for being here. You said that this is a debate that you expect is going to go on for hours. But I know that you're manifestly in favor and you are going to campaign for NATO. So the obvious question is, why now?
Well, we all know what happened in 24th of February, and that changed everything. We have had very strong line in Finnish foreign and security policy, but now it's changed. It's totally changed. Our neighbor, has it changed? Well, maybe there has been signs for it already, but I think now Finland, it's time to make another decision and show our way and our new decisions.
And this decision, your Prime Minister Sanna Marin said we need to make it in weeks. This is not months. We need to do it quickly. Do you expect to see a big majority here? And ultimately, I guess the question is, are you going to be in a position to apply by June? That is seen as a deadline?
I think there is already quite big majority. As we see in the polls, the Finns have changed their views and the ideas totally what they have thought before about NATO. And so it's at the parliament. But now we need a process. We have to take care about hearings and listening different officers and people who are working with NATO issues and also security policy issues. So that's why today this is a very meaningful debate to start with and to take this issue to different committees.
And the government has made it clear they want this done by June when there's a very important NATO summit that's expected to happen. But I wonder, you say the public perception has changed. You share a major border with Russia. You have a complicated history with Russia in the past. Do you fear perhaps that Russia could retaliate if you put forward this nomination? The Russians are saying for us it could be a problem.
Well, we all know what Russia thinks about NATO. And we will take care. We will take care of it, but we don't let that to make any difference to our decisions. We make our own decisions here, from our own perspective, and what we think what is best for the Finns and the security of the whole Nordic.
And what you say now in this white paper also was presented last week is that essentially you now name Russia as your biggest issue when it comes to foreign policy and security. So the question is this your biggest threat? Do you look at Russia and actually now see a dangerous neighbor?
Well, I think we don't have to think about different, Russia is only threats. We have every kind of threats that now we have to talk about and how this situation in Ukraine affects whole Europe. And that's why we have to also think what's the Nordic countries, what the European countries, and how will this change the architecture of the security policy. So I hope, because the report is quite short actually, I hope we will have a good hearings in the committees with different perspectives. But I think still we have to be quite fast.
And get it done quickly. Well, thank you so much, Mr. Vaska, for joining us here today in Helsinki on this decision, Francine, which is meaningful. I mean, this is undoing decades of foreign policy happening in real time and very quickly as a result of the war in Ukraine. But the goal of this government seems to be get it done in weeks, be able to present it in June, and then you would have a new member joining NATO. Again, it's a huge change to the face of European defense, Francine.
Yeah, and of course, everyone was wondering how Vladimir Putin would take that if it were to happen. Maria Tadeo reporting live from Helsinki. Coming up, we speak to Hendrik du Toit, the chief executive of asset manager 91. Send in your questions on IB Plus TV Go. That's next. This is Bloomberg. Chicago Fed President Charles Evans expects the Fed rates to go beyond neutral next year, while Atlanta Fed President Raphael Bostic says the central bank should retain some caution. Cancel culture Netflix plunges 25% pre-market as it loses customers for the first time in a decade and signals more pain ahead. And stay with Bloomberg Surveillance Early Edition. This hour we speak with Hendrik du Toit, the chief executive of Asset Manager 91. You can send in your questions on IB Plus TV Go. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Let's check on the markets because they're not dull at all. If you look at European stock 600, they're actually holding on to the gains 0.4% higher. U.S. indices, though, the futures are actually falling. Again, investors weighing the impact of rising real yields on the appeal of riskier assets, which is why we're seeing a bit of pressure on the NASDAQ futures, down 0.7%. Netflix also dampening some of the earnings season outlook. And then you have, of course, all the question of what that means for yen at 128.64, rebounding from a 13-day slump, gold extending its decline. The other story we're watching out for, and we had a great roundup by our reporter on the ground, that is, of course, our Marion Hoftmeyer, is Credit Suisse. Now, they're coming out with earnings next Tuesday. They're signaling today that their first quarter loss, or that they will have a first quarter loss because of Russia and some of the legal provisions that were previously indicated. We're just trying to figure out when Credit Suisse will catch a break, if anytime soon. That stock price down 1.7%. Now, streaming giant Netflix is losing customers for the first time in 10 years, with shares tumbling in pre-market down 25%. Despite hits such as Bridgerton and Squid Game, co-chief executive Reed Hastings says he's planning to create a lower price version of Netflix services that includes advertising.
I'm a bigger fan of consumer choice, and allowing consumers who would like to have a lower price and are advertising tolerant get what they want makes a lot of sense. So that's something we're looking at now. We're trying to figure out over the next year or two.
Well, Bloomberg's Laura Wright has been across the results. Now, Laura, the question is it because they don't have good enough content, because content is king, or is it because people are cutting subscriptions because they worry about inflation and household spending?
Really, inflation and household spending is the primary reason. Francine, minus 200,000 subscribers for the first quarter, well below the street's estimate, which was for an addition of 2 million. Netflix withdrawing from their Russian operation certainly played a role, but the forecast for the current quarter even worse, minus 2 million users. Now, Netflix are facing a trio of headwinds. Of course, the cost of living, inflation at the forefront of consumers' minds, economic reopening, and increased competition, the likes of Disney Plus and Amazon Prime. This year alone, both Netflix and Prime, they've both increased their prices to deal with the rising costs of studio and extra production costs. Disney Plus remains the younger platform. It's why it's cheaper. They're trying to gain more market share. And Netflix, they reference the conundrum, what to do with the 100 million households who piggyback off existing users' accounts. Netflix, it's lost its position as one of the pandemic darlings off the back of that tech rout at the end of last year and the subscriber revision downgrade in early January. But as we saw in that clip earlier, Francine, one way to entice new customers onto the platform is to reduce the price, and that will include advertisements. But we'll have to see, Francine. Content is king. The latest thing I watched was Bad Vegan.
Yeah, I didn't watch anything on Netflix recently, which maybe I'm part of the problem. Thank you so much, our Laura Wright there looking at Netflix. Now, U.S. 10-year real yields turning positive overnight for the first time since 2020. Investors are pricing in a more aggressive Federal Reserve as it tries to bring inflation under control. Now, here's what two regional Fed chiefs had to say on the issue.
Obviously, if inflation for some reason began to reaccelerate, I think that be a cause of great concern. I think that, on a path that included these 9 increases for this year by, December, on the way to December, you'd be looking for any confirmation of the storyline.
1 year from now, that's a really hard forecast to make. I mean, we have to make forecasts and we do our best, but things like China, supply chains, new variants, what happens in Ukraine, those are giant elephants that are going to determine what happens to our economy as well.
Well, joining us now is Hendrik du Toit, Chief Executive Officer of asset management firm 91. Hendrik, as always, thank you so much for joining us. Look, okay, we finally have a U.S. real yield that's positive. How big a deal is this? Could it rip up the global markets?
Francine, firstly, real yield is actually the normal state of affairs.
We forget.
We've been in a very unusual world. And in that sense, I think this will allow capital markets over time to normalize, to price risk appropriately, and probably avoid bubbles. So I'm a child of the 70s, when I got my mind in the 70s, my economic mind, and in the 80s, which means I've seen what havoc indiscipline, particularly financial indiscipline, can impose on society. So I'm not too worried, but short term, this is going to lead to volatility, readjustment of asset portfolios.
Yeah, I was going to say, yesterday it was funny. I had a coffee actually with a pretty big person in the hedge fund world, and he was telling me about his thesis of inflation like 3 decades ago, and how interesting, because not a lot of people realize what it did in the 70s and 80s. What does it mean for where you see money coming out? Like, are you readjusting, some of your portfolios? And again, why did we not see this coming?
I think some of us saw it coming, but it's very difficult to fight market forces. When you get crowded markets, narrow markets, enforcing very different levels of valuation for what actually should be fairly similar cash flows, it's very difficult to fight the markets, and I think investment managers tend to live closer to markets rather than far away, because they simply don't have the luxury. They have withdrawal of assets. But we were all awaiting for this. We've been planning for this. I've been saying on the show actually for a long time, you want robust balance sheets, etc. You don't want excessive gearing, and that is now really playing out.
Yeah, so the tech stocks, what, you just dump?
Yes. No, I wouldn't just dump them. I would say tech, if you look at the last 10 years, we've had a very narrow tech leadership. But if you look at the last 5, 10 years, not just 3 and 1, tech has done exceptionally well against everything for structural reasons. But there's a point, as we saw in the Netflix case, where you actually say this growth can't be priced forever, and the market regains a certain sense of caution, which is what's happening right now.
So Netflix is more of a valuation problem. You don't see it as a business model problem.
It's a great business. It's a great
business, but are people migrating to Apple TV? Or are they migrating to Amazon? Is it a crowded space?
It's the big animals, the big beasts starting to regain composure and taking back market share that they can take, and Netflix will have to live within that world. Right. Doesn't mean that Netflix isn't the leader, isn't going to be a winner for long run, but at the right price.
So you're telling me this is like a welcome correction?
I think if you do what we do, i.e. you professionally invest in markets, you use very tried and tested methods, one appreciates having a discount rate that is positive.
Right.
One appreciates risk being priced appropriately, but I think we're going to have political interference in markets for a while, which means you're not going to have an easy run, a very predictable market, because
Right.
there are other things at play.
So what do you mean? This is what central bank policy, that they're, that
central
they're
banks
behind
behind the curve, a world that is moving from a unipolar to a multipolar world in a very messy way, which means the rules basis. I mean, what we see now in supply chain shortages is not just Ukraine. It started under the Trump regime. Or Trump government, and you've had a ripping off of an order that has served humanity quite well for a long time, and the world is adjusting, and there is obviously pain points in that process.
And that's not priced in the market. So are you expecting more supply chain dislocations? And so if you're more nationalist, or at least if you change supply chains from parts of the world closer to home, it's automatically inflationary, isn't it?
Not necessarily, but it's costly. Look, inflation is sustained price pressure over time, not price shock. So, you know, but that price shock can upset and can change behavior, which may lead to inflationary demands being built into an economy.
But inflationary costlier isn't the same thing, or is it
no,
relative?
Inflation is sustained price pressure over time as opposed to single cost adjustments. Very important people remember that.
Yeah,
so that's the same point with oil now. Is oil going to stay where it is, or is there an energy transition coming? We don't know. That's the million-dollar question.
Okay, we'll talk about that. You've front-run me. Hendrik du Toit there, Chief Executive Officer of asset management firm 91. Stays with us. We'll have a lot more with Hendrik a little bit later on in the program, and we're going to talk about this idea of supply shock. Coming up, as Ukrainian defenders in the city of Mariupol say they are outnumbered by Russian forces, we'll bring you analysis of the situation. We speak to Leslie Vinjamuri from Chatham House next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Ukrainian defenders at a steel plant in the port city of Mariupol have said they are outnumbered and have appealed to world leaders for help. This as Russia sets a new deadline for later this afternoon for Ukrainians in the area to lay down their arms and surrender. Well, Ukraine's deputy prime minister says the humanitarian situation there is catastrophic. Joining us now for analysis on the wider situation is Leslie Vinjamuri, director of the U.S. and Americas program at Chatham House. Leslie, of course, the most difficult question is we're also talking about Finland and Sweden accessing NATO. Unclear how Vladimir Putin would put that. But, I mean, from where you stand, and you're an expert really in geopolitics, and from the U.S. perspective, how could this end?
Well, I think that the very sad reality is that there is no immediate end in sight. And of course, what Russia and Putin in particular are witnessing is exactly what he didn't want to see: Western unity, probably more NATO expansion if Sweden and Finland do move forward and NATO accepts their membership. And NATO, of course, as we know, has been one of the things that he has protested the most over several months, over several years. But I think that, the offensive in Donbass, his decision to really double down there while still, the fight is ongoing in Mariupol show, and the Ukrainian resistance, right? The determination of the Ukrainian forces to fight, and of the West to continue arming, to continue the sanctions, to try and to escalate those sanctions. None of this shows any likelihood of receding anytime soon. And the question now, of course, is, if we think ahead to this week, we've got the IMF, the World Bank meetings in Washington. There's a real struggle now for how the rest of the world beyond the West, maintaining Western unity, number one. Number two, what happens to India? What happens to the global South in this discussion of the war? Because the real risk is of a real fracturing, I think, as we move forward.
Leslie, do you see this fracturing? I mean, one of the conversations that we were having around the economy is also, if you're China, why would you buy treasuries if then they can do to you what the West is doing to Russia in terms of sanctions? So again, are we underestimating the profound impact this could have in terms of a fractured world?
Well, I think there is a potential for that, and that is certainly what the Biden administration will be thinking about, what Europeans should and undoubtedly are thinking about as they approach these meetings, is that there's got to be global solutions for making, an increasingly difficult global economic situation, inflation, and the likely impact and policy response to that, which will hit the global South. If the United States wishes to broaden its coalition of support in this struggle with Russia, it's going to have to come up with the realistic solutions where the consequences aren't so grave economically. And I think that, again, we're seeing some struggles with getting greater sanctions together in the US. We're seeing pushback across the West. We're seeing pushback within Germany from the unions on the question of further prospects for energy sanctions. And across the rest of the world, there's a potential for very significant consequences.
Yeah. Leslie, do you see actually China boosting strategic ties with Russia? And what does this mean for the rest of the world?
I think this has been, one of the most concerning things that we all know. We've heard from many people, and I think it's exactly true that China hasn't wished for this kind of war, hasn't wished for war in general, would prefer, stability in the global economy so it can continue its economic and strategic objectives, but it hasn't been willing to pull the plug on Russia. It's maintained a very fine balance, and there's a real concern that absent effective diplomacy, that this relationship between Russia and China will become stronger, not weaker, that it will extend beyond that bilateral partnership, and again, with very significant potential consequences. I think the question here now for the United States, for Europe, is how to maintain a very firm line when it comes to Russia in the face of grave atrocities, a very devastating and destructive war, while trying to pursue diplomacy that doesn't push others further away.
Yeah, that fine line. Thank you so much, Leslie. As always, Leslie Vinjamuri, Director of the U.S. and Americas Program at Chatham House. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gehrens. Hi, Leanne.
Hi, Francine. Sources say private equity firms, including Blackstone and Vista Equity, have ruled out financing Elon Musk's takeover bid for Twitter. Brookfield Asset Management is also said to have opted against backstopping Musk's unsolicited offer. At $43 billion, the deal would be one of the largest leverage bailouts on record if it does go ahead. And the days of free lunch are over at Goldman Sachs. The investment bank said that it's transitioning back to the pay-for-meal service for breakfast and lunch on April the 25th, scrapping a pandemic perk. Wall Street firms have used free food as part of the push to bring employees back to their desks during a pandemic that has fueled the rise of hybrid schedules and remote work. Goldman has been one of the most aggressive financial firms in pushing for a return to the office. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Coming up, could Russia's war in Ukraine mark a turning point in the world's reliance on the U.S. dollar? That's one of the key points from Global Investment Manager 91. We'll get more with the Chief Executive, Hendrik du Toit. That's coming up next, and this is Bloomberg. Now, could Russia's war in Ukraine mark a turning point in the world's reliance on the U.S. dollar? That's one of the talking points from the Global Investment Manager 91. And now they say weaponizing finance to punish Russia for its invasion could prove an expensive decision for the West and give rise to a more fragmented financial system. Well, we're back with Hendrik du Toit, Chief Executive of 91, who's back with us. Hendrik, this is a key point. And actually, if the Fed starts normalizing, selling treasuries, who would buy them? If you're China, if you're Kazakhstan, if you're any other central bank, and you say, right, well, I could do something that at some point would make the Americans angry. Why would I buy treasuries?
And who owns the growing reserves? Those are right now the oil producers or the energy producers. So we have an interdependent global financial system which we built after the Bretton Woods collapse in the 73 change in the arrangements. And we need to understand that served humanity well. If we are now going to overly weaponize the US dollar, there may be a period of not only instability, but a lack of capital where most needed. Now, the US, for example, as the anchor of the global economy at the moment, needs capital.
No.
It actually is a significantly
Hendrik,
reliant on foreign bond purchases.
But are we underestimating the deep impact? I mean, I was looking back at some of the debates we did in Davos, and there was one 5 years ago looking at devaluation of currencies. I mean, that was so quaint because that was our only concern. Now there's like concerns coming at it from all sides.
Yeah. And I think being no expert of crypto was a canary in the coal mine. There were people saying there is a problem down the line. And to me, what we need right now in the world, two things. We need political diplomacy. We have virtually none of that right now. We have screaming. And without that, you're not...
Whose job is that, though? The US?
It is all sensible and civilized nations. And we need to... even people who are reprehensible should be spoken to, because otherwise the shooting continues, unless you're willing to wage war. Second point is we need financial diplomacy and leadership, and that has to come from the US and China to work out an order, because the more you threaten this weaponization, the more the withdrawal will be, and the more the implications for trade finance, for ordinary investment flows, and I don't think that is good for the world, period.
I mean, I was going to equip that, Emmanuel Macron, certainly on the phone with Vladimir Putin, we think a number of times. But, I mean, this is all political and geopolitical, big thinking questions. As a market participants, do they think it doesn't touch them? And is that a wrong assumption?
I think it's... I mean, the markets have for a long time lived in a world of extreme political and structural stability, i.e. falling interest rates, falling inflation, benign economic and trade environment, and kind of unlearnt to be sensitive to that. I think we're in a phase now where we have to be extremely sensitive, and one of the things we've put into our next 10-year scenario planning now is the question of what does bigger state in market and in non-market economies mean to all of us? And I think we have to apply our minds and be very, very aware of the risks, as we've seen of late.
Okay, what does it mean? Market dislocations?
I think it means being very careful when you go to anything that is near political risk or priced to perfection. So, for example, treasuries were priced to perfection a year ago. They have lost about 7 or 8%. That is the low-risk asset, because we were assuming perfection, no rise in inflation, no change in the interest rate environment. It was just wrong.
So all of this, what does it mean for ESG? Is now that on the back burner because we're dealing with oil shocks?
ESG is front and center. And I can give you the 91 perspective. We still think the one thing we cannot forget is the sustainability challenge, and particularly the decarbonization challenge. And
that's your take, but the market is also aware of this?
Markets are all over, because some people are interpreting ESG as interference on every social issue. Some people are saying most countries in the world are not investable. Well, if that's the case, you're not going to have a better world.
All right. On that note, maybe we leave it there. Hendrik, thank you so much. Hendrik du Toit, there, Chief Executive of 91, joining us this morning. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kailey Leinz in New York, or Anna Edwards here in London. I know they'll take you through some of the market moves, huge market moves that we've seen after the real yield finally in positive territory. U.S. futures seeing a bit of pressure. Their investors are weighing the impact of rising real yields, for example, on the appeal of some of the riskier, the richer valuations. Netflix also dampening the earnings season outlook. If you look at what the impact of U.S. 10-year real yield turning positive is, it's the first time since March 2020, and of course it could reprice the markets in all asset classes and also across the globe. So that conversation next. This is Bloomberg.
It's been a brutal year for big tech.
I think you've got to look kind of beneath the hood of the market a little bit there.
Talking about growth again and talking about valuations and talking about equities is very critical.
The issue that's facing tech isn't so much a fundamental issue as it is a valuation issue.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Wednesday, April 20th. Our top stories today. Netflix shares are dropping in pre-market trading after losing customers for the first time in a decade. Meanwhile, it's Tesla's turn in the spotlight. The electric car maker reports earnings as its CEO Elon Musk keeps pursuing Twitter. Investors weigh the impact of rising real yields. High-priced tech stocks are likely to be under the most pressure as the move undermines valuations. And Ukrainian troops risk being encircled by that new Russian offensive as China says it wants to increase its strategic ties with Moscow. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, plenty to talk about on the geopolitical front, which we'll do later in the program. But from a market's perspective, the focus firmly on technology as we approach the US session with higher real yields and Netflix earnings in focus.
Yeah, tech is absolutely front and center, Anna. So too is the monetary policy picture here in the US as well as in Asia, where policy is a lot easier, at least in China and especially in Japan. Now, I would note from an equity perspective, it was a mostly up day in Asia overnight. The exception, though, really was Chinese stocks. They were down about 1.5%. You did not get an LPR cut overnight. That was what investors were hoping for, that policy would be continuing to ease in the face of some of the economic challenges the country is facing due to its COVID-0 policy, but instead that was held, so that disappointing investors a bit. Policy, though, definitely is easy in Japan, and the BOJ is committing to that easy policy with another bond buying program overnight, really trying to keep that JGB yield under the 25 basis point cap, having some success in doing so. That's basically where we are trading at the moment. Japanese equities giving a lift. What's interesting, though, is that you aren't seeing weakness in the Japanese yen as we have been seeing so often in recent weeks, even as the BOJ really doubles down on keeping policy easy. A little bit of yen strength coming through. 128.43 is where we trade, Matt, although that is still right around the weakest level in about 20 years.
Yeah, 128 yen. That's going to make U.S. car makers happy for $1. Let's take a look at what's going on here in the U.S. Nothing to do with car makers really today. It's all about Netflix. S&P futures down 0.25%. And remember, the S&P was up 1.6% yesterday. The NASDAQ had even bigger gains. Netflix itself was gaining more than 3%. So we'll see a lot more about Netflix throughout the program, but that's really going to drag on U.S. equities today. The 10-year yield at 2.90, coming down just a little bit, but also holding near highs that we haven't seen since 2018. NYMEX crude bouncing back a bit at a relatively high 103.66 a barrel for Texas Intermediate, and Bitcoin coming up as well. So this is interesting. The Bitcoin gain on a day when it looks like futures and the cash trade are going to come down after the bounce yesterday and after, the really disappointing, I think for some people, Nathan Moffat called it shocking. So it's a huge about face, he said, in terms of what Netflix has been delivering.
Yeah, and what does it tell us about that business model? What does it tell us about the U.S. consumer? Many ways to explore that story, and we will do that. Let's get to the European trading picture then, Matt. And we've got European equity markets actually playing catch-up with the United States. So Matt mentioned there the gains we saw on Wall Street yesterday. And so European equity markets really catching up with that, even though that is yesterday's story. And the fact we see a pause in what seems to be that higher and higher yield story, perhaps that giving investors a reason to buy risk assets as well. Interesting to see that technology stocks are the best performing here in Europe this morning, or they have been for much of this morning's session. Technology here in Europe, of course, a very different beast to technology over in the United States when it comes to business models, where it drives its profits and the level of profitability, of course. I put in the German Bund yield. I could have put in the UK gilt yield as well, just to underscore that we have seen a change in that particular story, or at least a pause in that story. We had been talking for weeks and weeks about higher yields. Today is a day where that story pauses for breath just a little bit. A lot of corporate earnings stories, or the preamble to corporate earnings stories coming through today here in European equities, and that's really interesting for us to note. Credit Suisse, that stock down by 1.4%. They've warned they're going to make a loss in the first quarter. This is the fifth time in the last 6 quarters they've had to issue a profit warning. This is to do with provisioning for legal costs, but it's also to do with the war in Ukraine. This is the Danone share price, the dairy business over in France, up by more than 8%. A French newspaper reporting there could be interest from a rival. Danone says, though, that it is committed to all parts of its business. Heineken, the drinks company, up by more than 3%. A apparently consumers are returning to pubs and to bars and drinking again, despite the fact that it's going to cost them more to do so. We did see that some of the gains driven by Heineken in the last quarter in terms of increased revenue were driven specifically by their pricing power, their ability to pass on those costs and put up those prices. These are some Russian assets for you. The focus very much on the ground, though, really away from what's going on in terms of Russian markets, really on what Russia is doing over in Ukraine. That is really the focus for us at this point. Interesting to note from a corporate perspective, though, that Shell says it is pulling back some of its employees from Russian projects, Kailey, which we'll continue to monitor as this just one of many, many European and global businesses that pulls out of that particular economy.
Yep, the list just continues to get longer and longer, Anna. Now let's take a look at what is ahead today. The Fed will be releasing its beige book at 2 p.m. New York time. There is also a key televised debate between French President Emmanuel Macron and his rival Marine Le Pen at 3 p.m. New York time. Remember, the second round of that election, the runoff, is on Sunday. And finally, in terms of earnings, Tesla will be reporting its results after the market close, Matt.
Yeah, that's one we'll be watching very closely. So streaming giant Netflix, I said we're going to focus on it. Losing customers for the first time in a decade. Management is pointing to growing competition and the sharing of passwords. And I've got to issue a little bit of a surveillance correct here. I'm a little bit worried that Tom Keene's going to be incredibly disappointed in me. I called Michael Nathanson of Moffett-Nathanson Nathan Moffatson. But you can see how I make that kind of mistake, right? Let's get over to Laura Wright right now. She's got the details on Netflix. Laura?
Thanks, Mark. Well, minus 200,000 subscribers in the first quarter. That is well below the average analyst estimate. They had expected an increase of 2 million. Yes, the war in Ukraine played a role because Netflix, they're withdrawing their operations in Russia. But even so, the projections for the current quarter, a loss of 2 million users. Now, Netflix, they're facing a trio of headwinds: inflation, the increased cost of living, competition, and economic reopening. The opportunity cost of Netflix and chill, or going out to restaurants, bars, seeing people in real life. Interestingly, both Netflix and Amazon Prime, well, they've increased their prices in the first 3 months of this year to combat higher studio costs. Disney Plus is the younger platform. That's why it's much cheaper. Disney's still trying to gain market share. And on the earnings call, we learned about the parasites, the households who piggyback off existing customers. Netflix, as you mentioned, implementing password controls. And in order to entice more customers onto the platform, they will create a cheaper advertising service.
Laura, we are going to get numbers from other tech giants, other giants of the US reporting season, the likes of Tesla. But we know that Tesla's boss has perhaps been distracted of late, and he's been putting out further cryptic clues about what his intentions are around Twitter. Bring us up to date.
Yeah, cryptic clues indeed, and that perhaps suggests why Tesla trading to the downside in the pre-market, because if Elon Musk is to go ahead with a private takeover, likely he'll have to sell some of his Tesla stock, which would send a negative sign to the existing shareholders. Now, this tweet in particular, something is the night. Is this a reference to a tender offer, coining the Scott Fitzgerald novel Tender is the Night? Or is it simply a reference to 420 amongst the cannabis community, which it is today? Now, that $43 billion unsolicited takeover, we're still waiting for a response from Twitter's board, but they have begun implementing some defensive measures. And a few private equity firms, such as Blackstone, Vista Equity, they've tried to distance themselves from the deal. But the world's wealthiest person, he's a polarizing figure. He likes to use a polarizing social media platform. And unsurprisingly, this is a polarizing takeover approach.
Yeah, not surprising at all. We will continue to watch this saga play out and continue trying to dissect and understand what exactly Elon Musk is talking about on Twitter. Thank you so much to Bloomberg's Laura Wright. Let's turn to monetary policy now. Chicago Fed President Charles Evans says he expects interest rates to rise above the level that neither restrains nor speeds up the economy next year. He addressed the Economic Club of New York yesterday.
Probably we are going beyond neutral. I mean, that's my expectation. When I see that taking out special factors, I'm still left with 3 to 3.5% inflation. That's not what we want. If we're the 2.5% inflation rate, I think we have more things to ponder there.
Meanwhile, Atlanta Fed President Raphael Bostic is wary of hiking rates to cool inflation. He said he's reluctant to support a, quote, long way beyond our neutral place. Well, the Fed's aggressively hawkish stance, maybe Raphael Bostic aside, has driven a turnaround in 10-year real rates as well. Let's get to Bloomberg's Danny Berger. Danny, it was for a relatively brief moment in time, but we were positive.
Yeah, we were positive, we're negative again, but of course it's this positive number that everybody freaks out at. Okay, is this the end of TINA? Do stocks not look as attractive because on that valuation metric, they don't look as good compared to real yields anymore? This was really held up as the pillar of why people were moving up the risk curve. But despite all of that, despite the assumed impact on stocks, on corporate credit, on the dollar, markets have been relatively well behaved overnight. We even saw U.S. stocks rally yesterday. So what is going on here? I was talking to Mark Cudmore about this earlier, and this is a chart for our radio listening audience of U.S. financial conditions from Bloomberg, but it's the plus index. So this is going to include some bubble metrics as well, like the housing market. Currently, in the past month or so, we have seen the loosest conditions that we have on record. They've been looser than the dot-com bubble, than the housing market as well. So until we start to see financial conditions really tighten, it's likely that stocks aren't going to face anything close to a bear market, Anna.
There's tightening versus recent history, and then there's tight conditions, and the two are not necessarily the same. Talk us through this really interesting story around JP Morgan losing its lead role on a senior underwriting role at one particular business in China, but does it have a bigger picture story to tell us?
I think the story is all about the bigger picture, Anna, because this deal itself, it's pretty small, just about $100 million is what we're expecting the underwriting to be for this company. It's called Kingsoft Cloud. It's going to list in Hong Kong. It's going to IPO there. It's a cloud company, as their name implies. Basically, you had a sell-side researcher over at JP Morgan cutting their price target on Kingsoft, calling the entirety of the tech sector in China, in Hong Kong, uninvestable. And then off the back of that, according to people familiar, Kingsoft took JP Morgan off the lead of the IPO, but they're still on the deal. So those things do indicate, okay, this isn't, the biggest hit to JP Morgan, but it really is indicative of this awkward relationship between sell-side researchers and the investment bank. Sometimes smaller versions of this play out, like everybody on an earnings call saying, great quarter, guys, to much criticism and lament from market commentators. But still, it is a careful balance. And sometimes, despite whether anyone admits it or not, it can play out in this sort of format.
Congratulations on the great quarter.
Exactly. Great quarter, guys.
Yeah,
Great
I love
quarter.
that. Danny, thanks so much. Danny Berger there talking to us about what's going on in terms of treasuries as well as JP Morgan in China. Now let's get to Russia calling this right now the second phase of its war in Ukraine. Early indications are that it could go better for Russia than it did the first time. Russian forces threatening to encircle an area at the top of the eastern front that holds as much as 40% of Ukrainian troops in the region. Let's get to Bloomberg's Maria Tadeo. She's in Helsinki outside the Finnish parliament because they are set to debate today whether or not to join NATO. Maria, what's the latest first off on the ground in Ukraine?
Yes, and Matt, with the war in Ukraine, this is a battle for Donbass. Remember, the Ukrainian Foreign Minister Dmytro Kuleba told us this is a battle that is going to remind us of the Second World War. It's everything. It's banks, planes, heavy artillery, tanks, all of this happening, of course, in that eastern Ukraine border. For the two sides, for Russia and Ukraine, this is strategically incredibly important. For the Russians, of course, it would give them not just a land grab in the east, but potentially this bridge that they've wanted from years all the way to Crimea and then de facto to the Russian Federation. For the Ukrainians, of course, they feel that if they're able to repel this attack, they will go into the real talks, which, remember, many believes won't happen until the question of Donbass is settled with the upper hand. Now, Matt, of course, you alluded to me being in Helsinki today, and we talk about the real-life implications that the war in Ukraine is having, the reverberations that is throwing across Europe. Well, this is a country that is a prime example of that. Today, debating whether or not it wants to join join NATO. It's about to undo decades of foreign policy. I've spoken to a number of officials here today that tell me Russia is now a threat to neighbors. We have a huge border with Russia, and we've seen at this point that economic ties, diplomatic ties, at times they just simply don't work. Russia is not scared to use force, and that's why it means that we should join NATO. The Prime Minister here of Finland says that this is a question that will have to be settled in weeks, not months, and the idea is that come June, Finland, but also Sweden, by the way, the Nordics, will officially apply to enter the alliance.
All right, Bloomberg's Maria Tadeo in Helsinki for us today. Thank you so much. Meanwhile, China says it will keep boosting strategic ties with Russia. A senior Chinese diplomat indicates the relationship remains solid despite growing concerns over allegations of war crimes in the invasion of Ukraine. Jack Fitzpatrick, Bloomberg government reporter, joins us now from D.C. Jack, the U.S. has warned China before about what would happen if it were to support Russia in any way. How is the U.S. likely to respond to this development?
Well, yes, the president himself has said that if China were to provide material aid to Russia, then there would be consequences for China. A little bit on the context of this statement, though, the vice foreign minister from China said that regardless of other international developments, the diplomatic relationship between China and Russia is important and will only increase. This was in the context of a significant increase in trade between the two countries in the first quarter of 2022. But keep in mind, much of that activity was before the invasion and before the sanctions from the West. There's actually a significant decrease in Chinese exports to Russia at the tail end of that time period. So this is a matter of reassuring words from China to Russia, but it doesn't necessarily tell us exactly what they mean when they talk about boosting diplomatic efforts. And if it is very significant, it would raise the question of if they're not providing military aid to Russia, at what point do American officials decide an increasing economic relationship constitutes some form of material support, which is exactly what President Biden has warned China about.
Jack, thanks very much for the update. Jack Fitzpatrick of Bloomberg Government joining us there from Washington. Coming up on this programme, Trevor Greetham, Royal London Asset Management's head of multi-asset. What does a very brief move into positive real yields move? What does it tell us more seriously about the longer term? And growing costs of Putin's war. Some Kremlin insiders fear the invasion was a catastrophic mistake, but see no chance of the president changing course. More from our big take story. That's still ahead. Plus, later today, Bank of America chairman and CEO Brian Moynihan. That's at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on both radio and television. I'm Matt Miller here in New York with Kailey Leinz, Anna Edwards with us out of London. Now, we just got headlines from Bank of America. Those strategists are going long the U.S. 10-year with a yield target of 2.25%. Right now, we see a 10-year yield at 2.90, so that would be a long way down from here, although we've come up from that level in fairly short order. I mean, just in the middle of March, we were below that, so it has taken less than a month for us to climb those, let me do the math quickly, 65 basis points, 65 basis points, sorry. Ksenia Galuchko, Bloomberg Equities team leader, joins us now out of London. Ksenia, you know, these things are all related, as we've seen, moves in yields in the equity market. What do you make of this call?
It is a very interesting time. So finally, bond yields are starting to compete with equity returns. So you would think that more and more investors would be going long treasuries. Well, actually, anecdotally, we're not seeing that happen. So if you talk to cross-asset strategists and investors in general, they still prefer equities because in equities, there's so much more diversification. You can go for different sectors, different plays, and the returns are still much more attractive than in the bond market. So for now, we're seeing equities as a more attractive asset class generally as a market sentiment.
Okay. Okay, and we'll see how the move higher in yields and the move to positive territory of real yields, whether that influences that at all. I'm thinking, of course, about technology and the strong run-up that we had seen, of course, previously in technology shares. It's interesting to see that here in Europe, technology stocks actually really to the fore and the best performing today. But that's not the US picture at the moment, is it?
Absolutely. But even yesterday, we saw the NASDAQ make a big bounce. So tech stocks have been very surprisingly resilient to the rise in bond yields. The main reason is that generally analysts say that robust earnings growth can continue in the tech sector. For example, today Citi came out with a note going overweight several major US tech companies. They're citing Amazon and Airbnb as some of their preferred stocks. So they're looking at particular companies. They're saying don't go along all of tech, but look at particular stocks and companies which can still show resilience and strong growth even in this rising yields environment.
Yeah, once again, a chance to be discerning, or a time to be discerning between tech and tech. Ksenia, thank you very much. Bloomberg's Ksenia Galuchko. And for more market analysis, please do check out MLIV Go on the Bloomberg terminal. That's the Markets Live blog. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Netflix shares are dropping in pre-market trading after losing customers for the first time in a decade. Meanwhile, it's Tesla's turn in the spotlight. The electric car maker reports earnings as its CEO, Elon Musk, keeps pursuing Twitter. Investors weigh the impact of rising real yields. Benchmark inflation-adjusted Treasury yields are back in positive territory for the first time in more than 2 years. High-priced tech stocks are likely to be under the most pressure as the move undermines valuations. And the new phase of the war in Ukraine appears to be going better for Russia. Ukrainian troops risk being encircled by a new Russian offensive. Meanwhile, China says it wants to increase its strategic ties with Moscow. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. A lot of geopolitics to discuss, Matt, and we did that a little bit with what's going on in Finland and the NATO conversation, really fascinating. But in terms of the markets, it's the real yields and it's the earnings from tech.
Yeah, absolutely. I would think Netflix is front and center. I will admit that yesterday I thought Jim Bullard suggesting 75 basis points was going to tank the index, and we climbed 1.6% by the close. So I was wrong then, and I could be wrong again. I will be wrong again very often. But right now we're looking at S&P futures down 0.1%. Netflix shockingly lost 200,000 subscribers and says 100 million families are using it without paying. So I would think that's a huge bummer for the NASDAQ. We'll see if that drags all tech stocks. The 10-year yield right now coming off a little bit, just under 290, but just at 289.18. And NYMEX crude up a bit at 103.48, so holding at a relatively high level, both of those things. Bitcoin is up just about 0.7%. We don't really see a lot of movement in crypto today, but it is interesting that we see Bitcoin, which normally has a high correlation with tech stocks, on the rise on a day when we'd expect some moves to the downside. In fact, let's see what they're doing in the pre-market. Kailey, what do you got?
Well, let's talk about Netflix first of all, Matt. It is absolutely brutal in early hours this morning, down 26% after its report after the bell last night. Analysts thought they would add 2.5 million subscribers in the first quarter. They lost 200,000. Plus, they said they're going to lose another 2 million in the current quarter. Yes, you have the problem of its suspension of service in Russia, but also a lot of people password sharing. I'm not going to claim guilty as charged on that one, but that is something that the company's trying to figure out potentially through advertising and cheaper prices for that model. And I would point out that's not just dragging on Netflix this morning. Other streaming operators are also feeling the pain. Roku is down about 6 percentage points. Disney down about 4.5%. The loss of customers, not a great sign for these companies either. And then, of course, the earnings focus is going to shift to Tesla after the bell today. It is down about 0.5% ahead of its report this afternoon, Anna.
A lot of corporate reporting in focus here in Europe as well, Kailey, and quite surprisingly, perhaps, given what we've heard from Netflix, technology shares in Europe, the European session, doing pretty well today, although technology here in Europe is a very different beast to technology over in the United States. That's one of the reasons the stock Europe 600 is up by 0.7% and actually has been gaining in the last half hour or so. So positive across European equity markets. We've seen a pause in that higher and higher yield story, and so maybe that's giving some people reason to reevaluate appetite for risk assets. but also we've seen earnings and warnings about earnings in some cases coming through. Let's start with one of those. Credit Suisse down by 1.6%, warning that next week when they give us the detail of their earnings, we will see a loss for the first quarter. And this is partly to do with provisions for legal costs, but also to do with the war in Ukraine. And that makes 5 out of the last 6 quarters where this business has had to warn about profits. Danone, that stock up by 8.7%. The dairy business over in the food and dairy business over in France. A French newspaper reporting they could be interest in all or part of this business from a rival. The rival not available for comment, it seems, and Danone saying it is committed to all parts of its business. Heineken up by 4.4%. The beer maker saying that people are returning to bars, returning to pubs and drinking beer, even if they're having to pay a little bit more for that. Of the increase in revenue that they saw in the last quarter, most of that was from higher prices that they were able to pass on to consumers. Here's a look at some of the Russian assets. Of course, the focus for us very much at this point is on what is happening on the ground in Ukraine and the difficulties that could lie ahead for Ukraine in defending the Donbass, in defending the eastern part of the country. Interesting from a corporate perspective that we saw Rosneft saying that they are trying to sell some crude right now and they want to take rubles for it, but they will take other currencies. That's interesting in the context of what's been going on in the discussions, similar but different, around gas, Kailey.
All right, Anna, well, let's turn back to Netflix, as I was talking about just a moment ago. As I said, losing customers for the first time in a decade. It's planning to introduce a cheaper advertising-supported option for subscribers in the next couple of years and crack down on that password sharing that I totally do not do. Let's get to Bloomberg's Alex Webb for more. Alex, is this a sign that peak Netflix is behind us?
Perhaps in the US, yes, that seems to be the indication. I think there is still growth to be found in other parts of the world, not least Asia. They did see 200,000 subscribers cancel their Netflix account globally, but they added 1 million subscribers in Asia. And you've seen a sort of doubling down, particularly on Korean language content, which does very well across Asia. So perhaps peak Netflix in the US, but it's a different story in the rest of the world.
And what's the story with stealing accounts or using accounts that you don't pay for? I mean, 100 million seems like a huge number. What can they do about that?
I mean, so yes, 100 million is what they estimate. Hard to know how they arrive at that number. It seems to be indicating some upside.
It's like twice the English population.
But that depends how you value the true value of Britons. But I think that ultimately, the calculation here is they're telling investors that there are 100 million subscribers we think we can still find. The other message is those subscribers maybe do not want to be paying $12 a month. And given that a lot of the equity story in Netflix has been evolving towards that point where it's like actually the growth is going to come from charging more, if those subscribers are only going to be addressable if you come with a $5 advertiser-supported approach, then maybe the upside is not as big.
Alex, so that's the story around Netflix. This is going to play, of course, this is going to run, and we're going to see what other kind of implications there are from this micro story. What about the battle for Twitter and the pursuit of Twitter that we see from Elon Musk? It gets ever more cryptic. He's giving clues, or is he giving clues as to his approach on Twitter?
Yes, he's sort of whacking the bee's nest and sort of seeing what comes out. It seems to me like as the CEO of Twitter said that there are going to be, troubling times ahead, or words to that effect recently. That is absolutely what is happening. Clarity is the last thing we have right now. It's hard to imagine the SEC doesn't look at some of this when they kind of see how the chips have fallen and see what Elon actually did and address these issues where he's kind of playing out a bid in public on Twitter without necessarily filing everything.
Alex, thank you very much. Bloomberg's Alex Webb with the latest on tech. We'll be back to that theme just in a moment, but we just got a red headline across the Bloomberg, which I should bring to your attention. Our colleagues here at Bloomberg have done an interview with the ECB governing board member Kazaks, who says that a rate increase is possible as soon as July. Perhaps that is a little earlier than some had anticipated. We've heard, of course, in recent weeks, or we heard last week from the ECB about the sequencing and about the timing of when they'd finish APP, and then people were drawing conclusions about when the rate hike could come. He's also saying that ending APP early in the third quarter is possible. comma, appropriate. We'll see how the market deals with that kind of headline. Let's get back to the tech theme, though, with Trevor Greetham, head of multi-asset at Royal London Asset Management, who joins me here on set in London. Trevor, very nice to speak to you. So you've been talking ahead of this conversation today. You say in your notes that you're underweight US tech and consumer discretionary. I suppose Netflix brings both of those themes together, doesn't it? Because you've got what consumers are doing with their money, but also a tech theme. Tell us the big picture then. Why underweight US tech? Does it have to do with the rising yield environment?
It does. If you think about why tech and consumer discretionary sectors did so well in 2020, it was because all of our spending was funneled into technology and nowhere else. And you had that collapse in real yields, which boosted the valuations. And you've got the reverse situation now, because you've got a strong world economy and rising pricing power. All sorts of companies can put through price increases. We're spending a lot more money on sort of gasoline and heating than we were before. And so you're seeing more of our spending directed to other places, and you're seeing that valuation support removed at the same time.
Well, Trevor, you talk about a strong global economy, yet we saw the IMF joining yesterday and cutting its global growth outlook. There is more and more talk of recession, not just in Europe, but potentially in the U.S. coming down the line. At what point do you anticipate that, and would that mean it is actually time to get back into technology stocks?
Well, yes, okay, two parts to that. The first thing to say is you've got a bit of a hump to get over first. So there's all this talk about doing 250 basis point rate rises from the Fed, or maybe a 75. Lots of rate hikes priced in, and they're needed because you've got this multi-decade high in inflation, and growth isn't collapsing. If you look at the US in particular, wages are rising, there's lots of people employed, there's a bit of a tailwind behind the economies. And so central banks will need to raise interest rates. And absolutely, you're starting to see the lead indicators that say there could be a recession. So the yield curve slope moving towards inverted, the spike in commodity prices, these are all quite worrying. But I would argue you've got that hump to get over. And when you get to the peak in growth, which could be, who knows, 3, 6, 9 months away, possibly even longer, then maybe some parts of tech start to look really interesting again. But the more defensive parts of tech that are going to be defensive in a slowdown rather than the sort of cyclical spending areas.
It looks like to me, Trevor, that this inflation isn't coming from monetary policy. So the only way that the Fed could stop it is by raising rates to the point where they really hurt growth. And you've even heard Bill Dudley say they've got to punish, for example, equity investors in order to achieve their goal. So isn't a recession almost a foregone conclusion?
I think it's very likely, but as you point out, the inflation is really supply side driven. It's to do with the fact that things are in the wrong place still, and we shut the world economy down and switched it back on again. So a lot of this inflation is hard to read, it's supply chain driven. And that could change quite quickly. So there is a possibility that inflation just melts away. And then you find the central banks can sit back and equity markets can breathe a sigh of
This is the
relief.
key question.
But I think it's more likely there's a hard landing.
How quickly can the ship right itself in terms of the supply chain, in terms of the chip shortage? When I talk to the heads of Volkswagen and BMW, as well as people running logistics companies and shipping and ports, they all say it's going to take a while, and it's not going to happen quickly. Cipsa from BMW said they're going to be chip shortage problems through 2023. So this is something that's going to take a long time.
Yeah, absolutely. I mean, at the moment, you've got to diversify quite broadly. We're overweight commodities. Our favourite market's the UK market, which is in a much less demanding valuation, much more exposure to these value sectors that can still see some good numbers coming through. And we're not yet bearish stocks, we're neutral stocks. But I agree, it could take some time to sort out the supply chains. And it may be that you need to get demand to come down in order to reach that equilibrium again. And central banks sometimes do need to create recessions. They very rarely admit it. They would prefer to view that later on as a mistake, but sometimes they need to do it if they're going to hit their inflation targets.
Right, and with all of that said then, Trevor, and the likelihood of recession or hard landing for the US economy, maybe for the global economy, where does that leave us with fixed income? Because fixed income's been really out of favour, of course, of late. Today we saw Bank of America strategists going long US 10-year treasuries, targeting 2.25%. We got from 2.25 up to 2.89 in quick order, but we could go back down. Where do you see fixed income then? Where do you see treasuries?
So tactically, we're still underweight treasuries and government bonds generally. So although we're seeing margin squeezes and downgrades beating upgrades now from corporate analysts, you're seeing positive macro surprises. So you've still got too much growth, I think, to start really overweighting treasuries. But from a strategic point of view, absolutely, we would defend the role of having bonds in the portfolio, because when you hit that peak in growth, and there won't be someone ringing a bell telling you the day it happens, you'll be glad you actually had some bonds in the mix.
Okay, too much growth, though, to be long of treasuries longer term. Trevor, thank you very much. Trevor Greetham, head of multi-asset at Royal London Asset Management. Coming up on the programme, the growing cost of Putin's war. Some Kremlin insiders fear the invasion was a catastrophic mistake, but see no chance of the president changing course. More from our big take story next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, Amazon Web Services CEO Adam Selipsky. That's at 4:30 p.m. in New York, 9:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Now to our latest big take story. Bloomberg's learned a small but growing number of senior Kremlin insiders are quietly questioning Vladimir Putin's decision to go to war. They believe the invasion was a catastrophic mistake that will set the country back for years. Mark Champion, Bloomberg senior reporter for international affairs, joins us. And I said a small group, Mark, but give us some size and scope about how small this group is, how senior or otherwise. What's the context?
Well, it is small. The Kremlin has always been divided between hawks, who they're called the Silovki, they're the power ministries, and those are the people who are really behind the war, the people whose ear increasingly over the last couple of years Putin has had. There has always been another group in the Kremlin who are more focused on the economy. And it's those people who are concerned because they know in the medium term that this is really going to have a pretty devastating effect on the ability of Russia to grow, to develop new industry, and so on. I couldn't put a number on it for you. I don't think anybody could. But these are the people who are concerned. We already know that there are some, oligarchs who are outside the sort of magic circle of Putin's immediate, friends from St. Petersburg and earlier days, and that they're unhappy. They're under sanctions. They've lost a lot of assets.
But it's too late right now, Mark, for a huge portion of the Ukrainian army, especially in the Donbass region, right? I mean, equally, every day we get new headlines from the Biden administration that they're going to send more weapons and more money, but that's also too little too late because the Russians have really surrounded a big portion of Ukrainian forces.
Well, they haven't surrounded them yet, and I think there have been most people have been surprised most of the time during this war, and the Ukrainians continue to surprise in their ability to hold back the Russians. The Russians continue surprised in their sort of lack of the kind of modern equipment and prowess that one would have expected. So it's certainly not a done deal. But yes, the amount of equipment that the Ukrainians need now in order to really succeed is really very large. You just burn through this stuff at an incredible rate in a campaign of this size. So the West will really struggle to get it there. Just remembering that just to get it from the Polish border to the Eastern Front is about 1,300 kilometers, and the Russians are watching. They've got drones in the sky. They've got missiles that they're attacking transport links with. So it's tough.
The supply challenge then of this war in the east of Ukraine. Mark, thank you very much. Bloomberg's Mark Champion. And remember, you can find out more from this exclusive reporting. NI Big Take is the function to use on your Bloomberg terminal to get more details on that story. This is Bloomberg.
I think when you look at things like treasuries, right? I think tokenized treasuries would be really interesting. I think you could provide transparency and real-time settlement of them. Getting rid of this sort of like T0, T1, T2 system that we have for various asset classes, right? With securities where it takes 2 days to settle a trade and there's sort of like some amount of uncertainty and risk and exposure during those 2 days. I think it would be really cool to see, real-time margining, real-time risk, and real-time settlement.
Sam Bankman-Fried, billionaire CEO of FTX, speaking with us on Bloomberg Crypto yesterday, talking tokenized treasuries, but also he'd really like to talk to Elon Musk about decentralizing Twitter. Let's talk more about treasuries now, though. Tom Keene, co-anchor of Bloomberg Surveillance, is joining us, and his single best chart is taking a look at them.
It's a real clinic here on the real yield, and what it comes down to is with the real yield ticking positive for a Matt Miller cup of coffee last night, the answer is the differential between the actual nominal yield surging higher, the 30-year bond towards 3%. There's a 10-year yield up, 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 up. And the space between is the inflation guesstimate. It is the nominal yield minus all that space. And notice the big inflation to the right, and at the beginning of the pandemic, the presumed disinflation and outright deflationary guess of long ago and far away.
You have a fantastic guest on today. I love talking to David Malpass, not just because he's the World Bank president, but because of his experience on Wall Street and in Washington, right? He served in at least 2 White Houses.
Yeah, it's true, Matt. And what's so good about Mr. Malpass is he has an encyclopedic understanding of the dynamics of the world economy. And you saw that with a markdown by the IMF, in particular, markdown by the WTO. So he knows the backdrop of this humanitarian crisis in Ukraine and the food crisis against GDP. So that'll be a good update here as the spring meetings of the World Bank begin.
Really looking forward to that interview. Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much. Now let's take a look at what else we're watching today. What I am watching, but apparently a lot less people are watching, is Netflix, because they lost 200,000 subscribers in the first quarter. They expect to lose 2 million more in the current period, and this stock is cratering in pre-market trading, down 26%. It could lose $40 billion in market value today. What's interesting, though, Matt, is how much is this going to read through to broader technology? Because I'm also taking a look at NASDAQ futures. They're on the cusp of positive on the day.
Yeah, S&P futures have turned higher as well. It's been a really interesting couple of sessions. I'm watching Tesla as well. A slew of earnings obviously out as we get into the heart of earnings season. But it's going to be interesting to see how well Elon Musk has done in terms of building, opening up, and producing in new factories around the world. He has consistently surprised investors on this one metric, just really growing output and revenues at an exponential rate, as Matt Winkler put in his column just a couple of days ago. Of course, we're all wondering about how the Twitter takeover is going. I'm not sure how much detail we're going to get on that, but certainly we'll get closer we'll get a little bit more on knowing what Cathie Wood's prediction, how realistic that is. Remember, she thinks Netflix shares can more than quadruple. I think she has now a $4,600
Tesla shares, not Netflix.
Tesla shares, sorry, Tesla. Thank you.
I don't think Netflix shares are going to quadruple today.
No, certainly they could go the opposite direction. But Cathie Wood thinks, 4,600 from 1,000. So incredible forecast, and we'll see if these earnings support that.
We will see how much he sticks to his Tesla script and how much he's lured off course, perhaps, into talking about Twitter. Let me tell you what is on my mind. I'm watching French politics. Marine Le Pen, of course, and Emmanuel Macron. We're gearing up for the final vote over the weekend. And tonight, in the run-up to that, we see the only live TV debate. Last time around in 2017, this was 2.5 hours long. It was seen as pretty crucial in Marine Le Pen's failure. Emmanuel Macron goes into this ahead in the polls. We will keep watching with interest. This is Bloomberg.